Hey guys, this is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profits newsletter. I'm coming to you today, this week, on Wednesday morning. Now, I had this video all outlined. I had my little script, my bullet points, things I wanted to talk about. And I was sat down about 5 o'clock last night. I was ready to go. Going to get it done on Tuesday, just like I try to most weeks. The week before, didn't do it at all because I wasn't feeling well. But we're back, so I'm already recording. My wife comes in and says, I've had a terrible day, long day at work. I want to go down to Rocco's Tacos, and I want to eat some Mexican food and drink some sangria. So needless to say, we're doing this on Wednesday morning instead of Tuesday because we were off to Rocco's Tacos here in Orlando. By the way, Rocco's has a few locations around the region. If you ever get a chance to wander on in there, a fantastic place for Mexican food, great bar. If you're fortunate, Rocco himself is in the bar that evening. He dances up and down the bar in a pair of giant Pee Wee Herman shoes, giving away free bottles of tequila and pouring tequila shots. It's really quite something to see. We've been there for that once. It was very entertaining, to say the least. But excellent food, great atmosphere. If you get a chance, free plug here, head on down. We always like it, and it is a great place to unwind after a not so good day, which apparently the wife had yesterday. So anyway, here we are. We've got our script. We scribbled a couple new notes on it with stuff this morning. Nothing all that big really going on in the world this morning. Yesterday morning, of course, it was a very different story as we woke up to those horrible tales of the bombings in Brussels. And now this is becoming a little more widespread and active in Europe. We just had the Paris bombings. Now we've got the Brussels bombings. Apparently the terrorist leader that they have in custody, won't even try his name here, has said they've got a new organization and new plans. Probably not done. All right. It's unfortunately, and this was one of my major concerns when all of this started, the refugee problem has turned into a terrorist problem. And it's not a blanket indictment of all Muslims, but if we apply some simple math, that if we've got millions of refugees coming from an area where as many as 2 or 3 out of 10 are radicalized Muslims, you've got millions of them sweeping into Europe. A certain and significant percentage are going to have at least terrorist sympathies. That's going to be a problem, and I'm not bringing this up to be even mildly political, but it's an economic problem in addition to a social problem in Europe. This type of terrorist activity is going to slow down tourist traffic. I promise you, I'm not going to Europe anytime soon, and this is a major reason for that. And I just don't really have any interest in going to Europe right now. But a lot of people are going to think that way. They're going to think twice before going to Europe. It is going to slow down tourist traffic. It's going to impact business. The social cost is going to be very high. And any dollars that are coming out of the economy going to solve social problems are not going to grow the economy and grow business and create jobs. That's just another one of those simple little mathematical facts. So Europe's going to have some problems with this. And I think it's going to be an all too frequent headline over the next several years. Until we get some kind of handle on exactly where the match is between the terrorism problem and the humanitarian problem. It's a tough fix, and I think it's going to take a long time, and it's not going to bode very well for the parts of Europe that have large refugee populations, unfortunately. Now, that's unfortunate because we've been really inactive in our international deep value portfolios just because not only don't we see a lot of value, we don't see anything that really looks to us like it's going to grow very well. Really have my eye on a lot of property-based investments in Europe, but not quite ready to pull the trigger yet. The European Commission is forecasting growth rates through 2020 of 2% or less. That's not good. That's horrible. But the stimulus is helping financial assets. They have some tailwinds. Imagine if they didn't have these tailwinds right now of cheap oil. The cheap euro relative to the dollar and other major currencies that make exports a little more attractive, and very low interest rates. But it's not doing a lot for the economy, and the political risks are substantial in Europe at this point in time. We still have the whole Brexit argument going on, and that terrorist attack yesterday did not help that vote at all. Significant problems throughout the Eurozone, not a lot of growth. To me, until asset prices come down over there, it's really not that an attractive a place right now to be real busy. We have a good presence in Europe. We've got a bunch of the European banks. We're not selling Europe. We're just not real enthusiastic buyers at this point in time because of the conditions in that part of the country right now. And we just don't see much outside of Europe either. We do have Brazilian positions. Brazil is a hot mess. You have to think it's been somewhere near the point of maximum pessimism, but we've thought that for a couple of years now, and it just keeps getting worse. Even the Brazilian investors that we hear from and talk with, not doing much down there at this point in time. There are some people looking at property and private equity investments. We keep an eye on that. We're tracking that. But, Rousseff has said she's not going to resign no matter what, which means possibly a quiet coup, certainly more disruptions in the street, and an absolute mess for the Summer Olympics. That's going to be really unfortunate because I don't think that they're going to be ready to host the 2016 Olympics. So not a great place to invest. Perhaps if the Olympics go as badly as they might, that could actually mark the real maximum pessimism and start a significant change in Brazil. We'll hold what we have, but we're not buying any more at this point in time. So anyway, I did read the CBRE Global Investors Expectations Report covering the global real estate markets yesterday. And it's pretty interesting. Of all the people they surveyed in the real estate investment, the institutional investment field, 82% of them intend to maintain or increase their current level of real estate investment dollars into more properties. However, significantly, they're all pulling back their horns, or they think so, okay? Because they're all concentrating on key, what they call core markets, your New York, your Bostons, your Miamis, your Londons, your Berlins, around the world, key urban established markets. Here in the United States, the best markets are New York, San Francisco, and Dallas, while overseas, London and the major German cities are ones they consider core and really attracting the dollar flows. Here's my problem with that scenario. Those markets are, to say the least, bid. They are not cheap. You're not getting any bargains. Everybody thinks that, well, my money's going to be safer there because there's all this demand, and there are key markets. The business isn't going to go away. The renters aren't going to go away. But you know what? This is faulty logic, and we've seen it lead to very poor results in the past. I hope it doesn't this time. Now, in the secondary markets, we're not seeing a lot of buying. We're seeing a little bit of price weakness, smaller cities, say a Tampa, I hate to say Philadelphia, maybe a Pittsburgh or Baltimore, and then on the West Coast, smaller cities out there where, there may be some bargains. This is reflected in the REIT market as well. The larger REITs are considered to be safe. Money is flowing into these things, trading at 3-4 times book value, massive multiples of earnings and operating cash flows, whereas some of the smaller ones, we've still been able to find some pretty solid bargains, and that's really where we're focused. That part of our portfolio is working really well for us at this point in time. So real estate markets, I've heard people call top in the commercial real estate market. I've heard people say that, we're in the early innings. I think that's both wrong. I think we're in the mid to late innings. I don't think we're topping. There's still too much money, too much liquidity. The economy here in the United States is not growing fast, but it is growing. There is demand for central business district properties. Multifamily demand is still strong. So we're not going to see maybe the price increases that we've seen in the property values over the last 5 or 6 years. I don't think we're quite set up for a decline. The interesting thing is many of the REITs that we've been most attracted to, the value of the underlying properties has gone up quite a bit since 2010, 2011. The share price of the REITs that we're buying haven't caught up very much at all. And we're getting these things now, as some of them at like 2/3 of management's estimate of net asset value. And that's just in some very attractive markets and asset classes across commercial real estate. We're really excited about that portion of our portfolio long term. And we're constantly looking for more. There's not a lot to get excited about in today's stock market, other than, of course, my community banks, which I'm going to get to here in a minute. But that small subsector of REITs that are not in the indexes and ETFs and not heavily traded is pretty exciting. Solid fundamentals, buying the assets at a substantial discount. It's hard not to get excited about that. Looking at it as a long-term investor with a private equity mindset, ton of money to be made in smaller REIT stocks at this point in time. Now, let's talk about Wall Street and unintended consequences for a minute. Now, the one thing that I tell everybody, and I was a broker for over 20 years, and I'm going to start out by saying this is not meant as a slam on retail stockbrokers, or what do they call themselves now, financial consultants, whatever they are. I was always a stockbroker in my mind. But they're well-meaning guys. They're hardworking guys. They're nice guys. They're family guys. They're big in the community most of the time. But they are salespeople, and they're given products to sell by their firms. And in any transaction, as you come to the table with a stockbroker or other financial professional, you have to keep in mind there's three people involved. Okay, there's you, the firm, and the broker. Two of those three people are going to walk away from the table as winners. One is not. Most of the time, the not is going to be you, the customer. It's a sales business. If you walk around downtown Manhattan and or Atlanta to any of the major financial cities of the country, and you look around at the skyline at all the buildings that are owned by the brokers, and you go into these buildings, and you've got the marble floors and the deep carpets and the beautiful art on the walls. That's not all there because of their philanthropic activities. Okay, there are some very good, conscientious brokers out there. There are also a lot of undertrained brokers who simply sell what the firms give them to sell. And believe me, the firm does not in any way, shape, or form care about you beyond its ability to keep your assets under their control, generating fees. They don't care about outperforming. They care about not performing badly enough to get you to pull your account. Now, in the years I was there, I'll tell you a quick story. When I was a new broker, my sales manager came in and he's like, "How many shares of this new product, Tim, can I count on from you this month?" And it was some sort of tax-free, maybe taxable closed-end fund. I don't remember the exact details right now, but I remember that, I had read the prospectus, which I know is against the rules technically if you're going to sell the stuff, and I really did not like this. They were using leverage to invest into an asset class that had appreciated substantially already, and the underwriting guidelines or credit standards for the portfolio were just not strong, not good. I mean, so we were going to sell a levered piece of not great bonds to the investing public, and we were going to sell this thing at $10 a share. We could tell them all day long no commission because we didn't charge an actual sales commission on it, but there was a fee of about 7% that came right off the top of the proceeds, of which I would have gotten 5%, which is a pretty good deal. So you think I might have been excited. No, I told him I wasn't selling that. I didn't believe in it. I thought it was a horrible product. He brought me into my office because I was a very young broker. He said, "Now look, it doesn't matter what you think of the product. People like the story of this product. It's a great yield. It's about 300 basis points higher than they can get at the bank. People will line up to buy this. You just got to tell the story." He says, "Look, you can't always feed the dogs what's good for them. Sometimes you got to feed the dogs what they like to eat." Well, never was comfortable with that approach. It's gotten much worse. In today's low-income world, people are starved for yield. Wall Street's all too happy to help by generating all sorts of slick and wonderful new products. And, over the years, I've seen them, guys. Real estate limited partnership, oil and gas deals, tax shelters that didn't. And we won't even talk about the horror story that is variable annuities that are just sold so often under so many circumstances where they should not be sold and carry 7 and 8% commissions to the broker, with your money being tied up with penalty and surrender charges for 7 to 10 years. These things to me are just an absolute nightmare. Your broker may be the nicest guy in the world, but when it comes to your money, he may not be your friend, and you need to keep that in mind. Now, law of unintended consequences. One of Wall Street's favorite things to sell is closed-end bond funds. Or closed-end funds of any nature. They'll sell closed-end equity funds with a managed distribution policy. That means they take a certain percent of the net assets and pay it out, so it acts like it has a really nice yield. There is usually they sell them as no commission offerings, of course, but there is that fee built in There's money coming out right off the top of the proceeds. So out of every dollar that you put to work, 92, 93% actually goes to work. Then it takes, I don't know, 5, 6 months sometimes for the money to get fully invested and start generating the promised yield. Um, just a horrible idea to buy one of these things on that initial public offering. That's the other thing. Everybody wants to get on an IPO, right? So if we've got an IPO for you, it's going to invest in these types of securities and it's going to give you this type of unit. It's a great story. It's easy to sell. No direct commission to you, Mr. Customer. Unfortunately, really not a great product for you. But now here's where it gets interesting to me as a value investor. These funds are now going to go on usually the New York Stock Exchange, and they're going to trade based, on supply and demand, just like everything else in the market. Once the brokers are done with the IPO, there's no reason for them to sell this. Now all they get is a basic stock commission if they trade this thing. Absolutely no reason for them to be pushing it. The research departments, well, there's no money to be made by them because institutions aren't going to line up to buy this thing. So we're going to have some supply. Some folks are going to realize that they don't want to own this thing. There'll be other reasons to sell. So we're going to have some supply. There's not going to be any demand. The price will fall. Quite often, the price falls to a significant discount to the actual value of the underlying assets. And this creates an almost, it's called closed-end fund arbitrage. It's not a true arbitrage, but if you could buy $1 worth of assets for 80 cents, and this happens every day in the closed-end fund world. If you look at Barron's each week and you go through the list of closed-end funds, they show you the discount for the various levels of funds. And there could be some tremendous bargains. I mean, I can remember buying high-yield closed-end funds back in the early 90s, and we were paying, 75 to 80% of the value of the underlying assets, and it just worked tremendously well. John Hancock had a regional bank fund that traded at a massive discount through much of the early 1990s, and that thing just turned into an absolute home run for patient investors. As recently as 2008, we were buying things like the Zweig fund at an almost 30% discount, as I recall, and then there was a huge discount in some of the Calamos convertible bond funds. So we bought those rather enthusiastically, and eventually, over time, demand, just because of the discount, because the asset class suddenly becomes popular, demand will come into it, and the gap will narrow between the net asset value and the stock price. And so you can get, if the asset class is going up, you get two, double whammy here. The discount's closing and the price is going up. So that's a great deal for investors. And if you're patient, you collect a lot of cash along the way. Most of them do have some sort of distribution program, or the fixed income ones are actually earning a yield. So you're getting paid along the way to wait for the discount to narrow. The problem is, of course, that can take several years. You can run out of patience waiting for this discount to close. Now, there's a whole new, factor in the marketplace. There's actually now, over the past 10 years or so, developed some closed-end fund activists. Now, the most aggressive is bulldog investors. I mean, they'll wade in, guns a-blazing, filing for proxy fights. They've got no problem coming in, filing 13Ds. They'll threaten a proxy fight. Today, a lot of the managers just go, okay, we're probably not going to win a proxy fight with these guys, so let's just see what they want. So they don't have to file as often. But they filed some 40 over the years, and they've won most of them either by outright gaining seats on the board. In fact, they took over one fund and now run it as kind of a little mini activist fund, and it's doing okay. Trades under the symbol SPE, Special Opportunities Fund. It does trade at a discount, but management's super aggressive about buying stock back and has done one tender offer at close to NAV. So they're being shareholder friendly about it. You might want to check that out because I think that the underlying investments in that are just really attractive. And you got, there's others, Carpus Management, a few others. They don't really want to do proxy fights because that can be a long, drawn-out process. But they do shareholder proposals and other forms of softer activism to help narrow that gap. So it's a pretty productive activity when you're doing your stock research. Put your little charts and whatnots and away and go to SEC.gov and start tracking these 13D filings on closed-end funds. Because all too often, that means that we're about to get into a serious discussion with management about closing that discount. So if you see a fund where 13D is filed, there's a discount of 15% or so in the underlying asset class, and it's a decent asset class and not something invisible or too opaque, then it's a good idea to get involved because you're going to collect some dividends. The discount should start to narrow, so you get a little double whammy, and you should be able to get mid to high teens total returns from that type of activity. We do use this activity in the deep value portfolio. We're probably going to be doing more and more of it as time goes by because it is quite lucrative. We've already had one fund that is going open-ended and has given us some nice gains. We expect to see more of that in the future. So we're always looking for opportunities. If you're out there, you should be too. This is not a heavily institutional area, so you've got a lot of confidence that Fidelity or somebody is not just going to come in, knock you out of the way from the bid, and you won't be able to get your shares, or somebody will bid it up to too high a price after the 13D filing. Not too many people are actually tracking closed-in 13D filing, so it seems to me to be a profitable and useful activity, and I suggest you take it up. Now, let's get to my favorite subject. We just put out last week the new edition of the Banking on Profits monthly newsletter. Now, in this newsletter, we do, I think, what is a great overview of what's going on in the banking industry and in the economy over the last month. And then really what we're tracking in this newsletter each and every month is buying activity. We're looking at stock buybacks. We do stay on top of what community banks have raised their dividend over the last month. But we look for new stock buybacks. We look for insider buying, which banks, officers, and directors are being aggressive about buying their own shares with their own money. We look at stock buybacks, and we pay really close attention to institutional buying. We track both 13G, passive positions of 5% or more of an outside investor in a community bank stock, and we follow 13Ds very carefully. That's where an activist investor has come in and taken a 5% position and wants to see changes that unlock shareholder value. Unlock shareholder value is simply a euphemism for get the stock price higher or I'm going to get mad and wage a proxy fight. Often these do in fact end up with a very favorable result, either a buyback or, with stunning frequency actually, a sale of the bank to a larger institution. So all that's tracked each and every month. It's only $199 a year. It's a bargain. You can make money with this. Let me show you how. Now, last year we did the March 2015 edition. We tracked 4 13D filings. Now, all 4 of those stocks are higher year over the year. The market, of course, is not that much higher. You would have earned, if you put just your money in these 4 stocks equally, about 16.25% over the last 12 months. That beats any fund or index or any of that other stuff that I'm aware of. This is a profitable approach. And again, we're doing 98% of the research for you. Okay, we're going to get you right up. We're like the cable company that comes in. We're the last couple of feet away from your house. You just got to hook that last couple of feet of wire up, and you're good to go. Now, we also identified 20 stocks where insiders were buying back stock. Where insiders were buying stock with their own money, open market purchases of the stock of the bank that they manage. There were 20 of them that did so, that bought stock at book value or less. So a little larger sample size here. Of the 20 stocks, 16 of the 20 are higher a year later. I'm just going to tell you point blank that one of the ones that is lower is Mid-South, and we never would have bought it in a million years because of the non-performing asset ratios were starting to tick higher, and they had way more energy exposure in the loan portfolio than I could ever be comfortable with. Having said that, I'm not going to take it out of the sample results. That would be sort of cherry picking and cheating. So 16 out of the 20 are higher, including said Mid-South Bank. And if you just bought an equal amount of all 20 a year later, your total return is 15.11%. Not bad at all given the current market environment. So Banking on Profit Monthly can and will make you money. And we can do this month by month by month by month, every month for the time period that the publication has been out. And it's a consistent moneymaker, particularly the 13Ds and the insider buyings at book value or less. We do all of the homework for you. You should be involved in the trade of the decade in community bank stocks. If you're not, you're just simply allergic to money or addicted to the action of trading larger cap stocks. Whatever it is, step aside, get some money into these community bank stocks. Banking on Profits Monthly is here for a very reasonable cost to help you along the way and make a ton of money in the trade of the decade. Anyway, that's all I've got for you this week, guys. I'm getting ready. I've got to go pack tomorrow. I'm not sure what's wrong with me. It's 80 degrees down here in Florida this week. Going to be around 84, 85 all week. So on Friday morning, I'm going to get up and fly to Chicago. My daughter and her husband live up there. We're going to go up, see them, spend some time with them over the little holiday weekend here. Fortunately, some of my pain is going to have the edge taken off of it. A very good friend with deep ties to his alma mater called and just happened to have a couple of tickets to the NCAA tournament. So I'm going to get to go watch some NCAA basketball while I'm up there. And that is pretty exciting to me. I've been to the ACC tournament. I've been to the NIT tournament a couple times when Maryland was in it a few years back. I have never been to the NCAA tournament. So really excited to go see that. Most of the year, I don't really, follow college basketball closely, but the tournament is a one and done, very exciting type of format. My friend and his colleagues are very passionate about their team, so it's going to be fun to be in that environment and watch some big time college basketball this coming weekend. Unfortunately, then I'll then have to go back outside into the 30-degree night to get back to my hotel room. But I'll be back in sunny Florida on Sunday night, ready to go for next week. And for subscribers and everyone else, there will be no Thursday publication this week. Okay, what we're going to do, because we're flying Friday, we're going to move everything up a day. And the regular Banking on Profits weekly service, weekly update will come out on Friday, as will the Deep Value weekly service report. And all the buy lists will be published on Thursday. So we're going to move everything back from Friday to Thursday. So that'll be coming out to you tomorrow. Now, the reading list will actually go up sometime late Friday as opposed to as early as possible, given household activities on Saturday morning. So you'll get those sometime Friday as you go into the 3-day weekend. Anyway, that's about all I've got down here in Central Florida this week. We're going to get busy finishing up our day, getting ready to pack, go to Chicago, freeze a little bit, enjoy some time with the family and some basketball, and hopefully you have a fantastic 3-day holiday weekend, and we'll talk to you guys next week. Don't forget, Banking on Profits can make you money. If you're not a subscriber, you should be. It's only $199 for Banking on Profits monthly. No excuse not to sign up. I'll put a link in the remarks section of the YouTube and Market5 videos. So sign up. Hope to have you on the team soon. Thanks, and have a great week, everybody.